This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me a new guest here this morning, Michael Snyder. Michael is a prolific writer on the web and is the publisher of the website The Economic Collapse. Welcome, Michael.
Thank you for having me on the show. It's really great to be with you.
We will continue from session 1, already in progress. Easy money and easy credit is the easiest thing to begin. It's almost impossible to get off, and there's actually been no country in the world that's ever survived it. When you lose sound money, you would really lose your ability as a democracy to continue to operate. That's very harsh, but there's never been anybody that's survived it. They end up always resorting to debasement of the currency, right from the Roman times. And that's the road that we're clearly on.
Yeah, and in my article, I didn't mean to imply that we had already gotten to where Germany got in the early 1920s. But what I was trying to propose is that we're on the way. We're starting down that path, and where it ends up is a nightmare. Now, on the mainstream media, what they've been trying to sell us quantitative easing as an economic stimulus program. They say if we do this, it's going to make the economy better. It's going to make lives of average Americans better. But what have we seen instead? As I mentioned earlier, we've seen median household income go down for 5 years in a row. We've seen the employment to population ratio. Before the last recession, the percentage of working age Americans that actually had a job, that were actually working, was about 63%. Then the recession hit and it plummeted to below 59%, and it has stayed there ever since. We've not seen a rebound, and this is the first time in the post-World War II era we've not seen the employment to population ratio, in other words, the percentage of working age Americans with a job. We've not seen it bounce back. In fact, it's been remarkably consistent at this low level. But so we really haven't seen any employment recovery. This quantitative easing hasn't been good for the average American, but who has it been good for? Well, as billionaire hedge fund manager Stanley Druckenmiller told CNBC recently, and this is an exact quote for him, he said, "This is fantastic for every rich person." And another quote he shared with CNBC, he said, "This is the biggest redistribution of wealth from the middle class and the poor to the rich ever." And what we've seen, quantitative easing, is we've seen a tremendous amount of money flood into the financial markets. We've seen the Dow, since it bottomed out, it's more than doubled since the depths of the last recession. So we've seen this, it's been tremendously good for Wall Street, for the financial markets, in other words, for those who have stocks and financial instruments, which are the very wealthy mostly. But for the rest of America, it hasn't been so great.
See, what we're going to is a two-class society, have-nots, the rich and poor. But when you get that level of inequality, it leads to eventually to social unrest. You need to really make a point here, Michael. These problems are not unique just to the United States. Europe has been in 6 quarters of a recession, which has promoted all sorts of problems in Asia because of the slowing economy right across the EU, never mind a non-responsive U.S. economy. It's a universal problem where the growth is not there. Matter of fact, in real terms, we actually have contraction.
As you mentioned, it's not just the United States that's facing these problems. In fact, Japan, on their scale, they're actually doing more quantitative easing, than we are. Compared to the size of when you compare the size of our economies, Japan, they've got a debt to GDP ratio over 200%. They're printing money wildly. They're desperately trying to deal with this tremendous amount of debt they've accumulated. You mentioned Europe, and many areas of Southern Europe are already experiencing a full-blown economic depression. So what we've got right now is this debt crisis, which is literally worldwide. It's really unprecedented in human history. The governments, consumers, businesses are literally drowning in debt. And so we're approaching this crisis, not just the U.S., but literally the entire globe is approaching this tremendous debt crisis. And when this thing bursts and comes apart, it's going to be incredibly messy.
Michael, this is the first time that we have actually had something on a global perspective, whether it was the Weimar Republic, which was really centered in Germany, whether it was our Great Depression in the United States. We went through, and even crises that we faced have always been very regional. But now this is first time something global, debt structure that now is right across the world. And so these problems themselves are all integrated, and what makes it so difficult to even respond to them, we have a very fragile and untested financial system. As an old engineer, we used to stress test something to make sure to know when it would break. We've never stress tested this. The system has evolved, and as things break, you kind of patch it. But when you get a system that this global and this complex, when something breaks, it will cascade very quickly. And we're reaching, in many cases, this kind of situation, this level of complexity. I have this chart up I referred to earlier, Michael, about the globalization trap, and I marked in here how these articles that you wrote all fit into it, because very much they're all integrated. I think just in our discussion, you can see, I think our listeners can see how they in fact do tie together. What's happening here is we have a global liquidity trap. And for those that aren't familiar with what a liquidity trap is, it's a situation described in Keynesian economics in which injections of cash into the private banking system by the central banks fail to lower interest rates and hence fail to stimulate economic growth. And a liquidity trap is typically caused by three reasons. People hoard cash because they expect an adverse event such as deflation, or there's insufficient aggregate demand, or there's war. And by war, there's a sense of absolute fear. And the signature characteristics of a liquidity trap are short-term interest rates that are near zero. Yes, that's what we have now. And fluctuations in the monetary base that fail to translate into fluctuations in general price levels. And yes, that's what we have here. So we have put ourselves into this trap that by printing more and more money, it can't possibly solve it. The propensity of return on that money is not there. It's not creating wealth. And wealth is not created by printing money. Wealth is created in another fashion. Either you build it, you mine it, or you grow it. You can't print it. And it all gets down to a lack of demand. When you go round this circle, when you have labor arbitrage, and therefore you get down where there's not enough real disposable income for people to do this kind of investment, governments are forced to do something with this mistaken belief in stimulation. They get into unsound money, and then it's the rate of aggregate demand growth. It's not that we don't have growth. As a matter of fact, I would argue we have negative real growth. But when that rate slows, that first derivative, the liquidity trap is sprung. Like I said earlier, nobody's ever been able to get out from under it.
I agree with you. And what we're seeing is only going to accelerate. I'm extremely concerned about another 2008 style financial crisis when we see credit freeze up, and the flow of because our whole system today is based on debt, based on credit. And when credit freezes up like it did in 2008, things can get very bad very, very quickly. And so I'm particularly concerned about another great financial crisis. And I believe the next one is likely to be caused by derivatives. We've got these hundreds and hundreds of trillions of dollars of derivatives sitting out there. You know, the big banks, they don't learn anything from 2008. They're still gambling recklessly, being tremendously wild, with their bets, and with these derivatives in particular. So I'd encourage people to listen for a problem with the derivatives. And because when there's the next time there's a derivatives crisis, that could freeze up our system and cause this liquidity problem to become a lot worse, where suddenly it seems like no one can get a loan, no one can get credit, no one can get money. And that could plunge us down into some very difficult economic times very, very rapidly.
I agree with you fully, Michael. I 4 years ago put a series of charts together that showed where we would migrate to And we were going to, in the middle of the financial crisis, I believe we would go to an economic crisis, which would lead to a political crisis, which we're at through 2014, which my charts end next year. But at the same time, what was going to fail was a sequence of financial instruments and leading through credit defaults. But the bottom right-hand corner of the chart I have up now shows that it leads to a breakdown in the swaps market. The $700 trillion swaps market, which is a form of derivatives, and they've been untested, which are supported by a $72 trillion shadow banking system, totally unregulated and unpoliced. And that's been temporarily holding the system together in spite of this liquidity trap. But unfortunately, why it eventually fails is all of debt collateral has to be held against it. And when the collateral itself reduces in price, you get what they call a margin call. You have to ante more collateral. We have a tremendous shortage of true high-value collateral. The whole reason the taper was being forced on the government and really needing to do it is because the TBAC was saying this, the magnitude of the collateral shortages for the banks was phenomenal because the U.S. government is consuming more than 1/3 of the bond market, which is reducing the collateral. So they had to free up more of that. But they quickly found out the moment they tried it, we had an emerging markets crisis. The point is that they're fighting this massive derivative problem right now.
Yeah, and there's so many of these tremendous imbalances in the system which are not sustainable, and many of the imbalances are working against one another. So it's only a matter of time before something starts breaking loose. And, I think what the Federal Reserve is, and one of the reasons they didn't taper, is they're so concerned about what's going to happen to long-term interest rates. One of the most important numbers I'm checking every single day now is the rate on 10-year U.S. Treasuries, because if that goes up, that pushes up mortgage rates and many, many other long-term interest rates in our economy throughout our financial system. But we've got so much debt in the system now that our system literally cannot survive without super low interest rates. If we go back to historically normal levels of interest rates on government debt, on mortgages, on everything else, it's just going to cause a catastrophe. But we've kind of painted ourselves in this corner now with so much debt that the only way that we can keep the game going is with super, super low interest rates. I would argue irrationally low interest rates. If interest rates start going back up, the game is over.
See, Michael, what's happening recently is that the real rates which have been negative and need to be made negative to sustain the government's debt, because remember, it's all about trying to make sure that the government's debt is sustained, have been creeping up and causing any number of problems. And, when we went into this G20 and the emerging markets were having severe problems because of the fear of taper, that is the reduction in the amount of hot money that has been flowing around the world, and it was suddenly being pulled back as a risk-off trade, was just shocked the Fed. But as these emerging markets were having to shore up their plummeting currencies that were falling rapidly, they had to sell their currency reserves that they've built large amounts over the years with this credit to protect themselves as they learned from the Asian crisis. But when they sell those currency reserves, we need to remember those reserves are held in instruments and primarily have been riskless U.S. Treasury bonds. So they were selling Treasury bonds, U.S. Treasury bonds, at a phenomenal rate. When you sell the bonds, interest rates climb. And so interest rates were starting to push 3% and maybe heading to 3.5%, which is a critical kinds of issues with carry costs. So we suddenly had to reverse that because it was causing horrendous problems. But as you correctly point out, if interest rates even begin to get close to normalization, we have a phenomenal set of problems. And it's my opinion, and I've been at this school for quite some time, that interest rates will be forced down again, and that we're going to see eventually a 10-year bond below 1%. As obscene and as that may sound, that's the only way out of this problem, which is another way of saying it's a complete debasement of the currencies. And the thing that keeps it together right now is the United States is the world's reserve currencies. Reserve currencies, and 4 currencies around the world are all playing this game together. Japan, as you point out, probably the biggest problem in the world, the euro, the sterling and the U.S. dollars. And so this currency cartel can currently play this game of debasement, but at some point it's going to implode, and I think that's the most worrying thing. Michael, any closing comments that you'd like to make on anything we've talked about here this morning?
Well, for people listening to this program, I would just encourage them to get prepared for what's coming, in terms of, we talked about Cyprus-style wealth confiscation. What the solution that I'm encouraging people to do is not have too much money in one place. Don't have all of your eggs in one basket. For example, retirees in Cyprus, they put all their money, many of them put all their money in a single bank. There was this retiree in Cyprus. He had worked all his life. He was just a regular working guy, and he had accumulated a nest egg of, it was about 900,000 euros, if I remember correctly, somewhere in that neighborhood. But he had it all in a single bank account in one of these troubled banks in Cyprus. And so then they come with this wealth confiscation, and everything above 100,000 euros was suddenly gone, essentially, almost overnight. And so I'm encouraging people, don't put all of your eggs in one basket. Spread it around. That makes it harder for the government or some type of disaster to come in and wipe you out. So spread it around. I'm also encouraging people to build up an emergency fund. Because, you go back to 2008, what happened? Millions of people lost their jobs, and then because they didn't have anything to fall back on, they couldn't pay the mortgage, and they lost their homes as well. So when rough financial times come, people need to have an emergency fund, something to fall back on, and any way you could become more independent of the system, I think is a good thing. Rough seas are coming. So, I'm encouraging people to batten down the hatches, get prepared, because, those that aren't going to be prepared for what's coming, they're going to have a very rough time.
Exactly, Michael. As negative as some of our comments have been this morning, this could be the greatest opportunities in life are when there's difficulties and there's crises and problems. And if you're prepared for them and you batten down the hatches, it's time to be diversified. It's the time to take out economic insurance, and that is things that will maintain their true store of value, whether that's things like gold or silver, but not just them. That can't be a single strategy. As you point out with the example in Cyprus, to make sure that you're really diversified even in where those assets and your assets you hold them. This is just being prudent. And I think we've had such great times for so many years that we almost don't believe bad times can happen to us. And I think it's just time to be more prudent and financially responsible. Michael, can you tell our listeners where they could learn more about your work and your writings?
Sure, absolutely. The primary website that I'm known for is called The Economic Collapse Blog. It can be found at theeconomiccollapseblog.com, or if you just go to Google and type in The Economic Collapse, it'll be the first result that comes up. And then also recently I published my first novel entitled The Beginning of the End. It's available on Amazon.com, and it's a novel that's set in the United States in the near future. And it's not just a story, it's a mystery/thriller, but in there I've included so much of what I've learned about the economy over the years, and I've included in almost every chapter nuggets of information for people to digest. And it's a great book you can give to a friend or a loved one, and they can read it and they can be entertained, but at the same time, they can be alerted to so many of these things we've been talking about today that are coming, but they can digest it in an entertaining format.
Michael, thank you very much for the time. It was a real pleasure, and I'm sure our listeners got an awful lot from it. Talk to you again.
Oh, absolutely. Thank you so much for having me on.
Thank you very much. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.